Welcome to The Explainer. Today, we're doing a really fascinating deep dive into a very specific corner of the financial sector. We're taking Capital Federal Financial and putting it through the ultimate investment gauntlet. We're going to strip away all the noise and evaluate this stock using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham before capping it all off with some rigorous modern quantitative modeling. So get ready, because we're about to see if this regional bank actually has what it takes to impress the greatest investors of all time.
All right, let's dive right in. Here's our roadmap for today. Number 1, company snapshot. Number 2, the Buffett lens. Number 3, the Lynch lens. Number 4, the Graham lens. Number 5, quantitative models. And finally, number 6, our synthesis and verdict.
Section 1, Company Snapshot, Capital Federal Financial, or CFFN. So, Capital Federal Financial, trading under the ticker CFFN. Now, this isn't some flashy tech startup, right? We're looking at a 130-year-old community bank rooted deeply in the Midwest. They've got a market cap hovering right around that $910 million to $1 billion mark, and currently, the stock is trading at exactly $8.62 per share. But what's absolutely crucial to understand here is that they are actively navigating this massive strategic shift. They're moving away from their traditional reliance on 1 to 4 family residential mortgages and aggressively expanding into higher-yielding commercial lending.
Let's anchor this in the hard SEC data. Capital Federal sits on a massive $9.83 billion in total assets. But more importantly for us as investors, their total stockholders' equity is roughly $1.02 billion. When we take that equity and divide it by their outstanding shares, we calculate a baseline book value per share of approximately $8.03. Now, tuck that $8.03 number in your back pocket, because it's going to be incredibly important when we start running our guru formulas in just a bit. Section 2, the Buffett lens, moats, management, and margin of safety. You know, Buffett loves an economic moat. And honestly, surviving 130 years in local banking definitely proves CFFN has some real staying power and customer loyalty. Their earnings are consistent, and as we mentioned, they're actively transitioning to those higher yield commercial loans to boost profitability. On the management front, they're incredibly shareholder-focused. In fact, since 2010, they have returned a staggering $2.06 billion to stockholders through dividends and massive buybacks. That is a huge green flag for Buffett. But here's the catch. The sticking point is their return on equity. It currently sits around 7.9%, which is significantly below Buffett's typical 15% target. That lack of capital efficiency might just give him pause. Furthermore, when we approximate Buffett's beloved owner earnings, we run into a little quirk about analyzing banks. You see, owner earnings closely mirror net income because capital expenditures for banks are generally very low. In this case, we're looking at an annualized net income of around $81 million compared to under $6 million in CapEx. Because that ROE is a bit sluggish, Buffett would likely demand a very steep margin of safety to buy in. So at the current price of $8.62, it's probably a little too rich for his blood. He'd likely wait for a pullback to the mid-$6 range before getting interested. Moving on to Section 3, the Peter Lynch lens, categorize and conquer. In Peter Lynch's world, you've got to categorize the stock first. And we can confidently classify Capital Federal as a classic stalwart. Look, it's not a fast grower that's going to triple your money in a year, and it's not a cyclical tied completely to massive macroeconomic swings. As a stalwart, CFFN offers a bedrock of downside protection primarily driven by its hefty 34-cent regular annualized dividend. That gives you a near 4% yield right out of the gate. Now, what's really interesting here is the sheer volume of share repurchases. While we lack explicit insider buying data, management repurchasing 5.46 million shares acts as the ultimate proxy for insider confidence. Factor in a price-to-earnings ratio of around 13.5x and a recent earnings growth spurt that pushes the PEG ratio down to a highly attractive 0.43, well, Lynch would likely view this as a really solid dividend-paying hold that simply won't keep you up at night. Section 4, the Benjamin Graham lens, the defensive investor. Graham designed a ruthless checklist specifically for what he called the defensive investor. And honestly, this is where Capital Federal really shines. Adequate size? Pass, with nearly $10 billion in assets. Earning stability? Pass. Uninterrupted dividend record? Pass again. They even pay out specials. A moderate PE under 15? Pass. They sit at 13.5. And a moderate price to book under 1.5? Pass, trading right at roughly 1.07 times book. CFFN impressively clears every single one of Graham's defensive hurdles. Because it aces the checklist, we get to use the famous Graham intrinsic value formula. The math here is simple. It's the square root of 22.5 multiplied by the earnings per share multiplied by the book value per share.
We explicitly pull our data inputs directly from the recent filings, an annualized EPS of 64 cents and that book value per share of $8.03 that we calculated earlier. When you run those numbers, the calculation spits out a fair value of exactly $10.75. So the crucial takeaway here is that with the stock currently trading at $8.62, CFFN offers a very comfortable 20% margin of safety against Graham's intrinsic value calculation. For a strict defensive value investor following Graham to the letter, this stock actually looks like a compelling buy. All right, Section 5, Quantitative Valuation, DCF, and Alternative Models. Valuing a bank takes a slight tweak to your standard discounted cash flow models. Because banks use debt essentially as raw material, we use net income as a proxy for free cash flow to equity. So we start with that $81 million annualized figure. We project some very conservative growth between 0 and 2% over 5 years. Crucially, we apply a 9% cost of equity as our discount rate, and we calculate the terminal value assuming a perpetual growth rate of just 1%. And this brilliantly illustrates just how sensitive bank valuations are to your underlying assumptions, particularly around interest rates. If we stick to our base case of a 9% discount rate and 1% terminal growth, the model gives us a fair value of exactly $8 per share. If you demand a 10% return, well, that value drops down to $7.11. Just to make sure our DCF isn't totally out of left field, we ran a few alternative models. A dividend discount model, which factors in their regular and special dividends, yields a value of around $7.60. Applying a standard sector median PE multiple of 12 to their earnings gets us to $7.68. It's truly fascinating how closely these modern models cluster in that mid to high $7 range, which you'll notice sits slightly below the current market price. Finally, Section 6, Synthesis and Final Verdict. When we bring all these different valuations together, a pretty clear picture emerges. Benjamin Graham's defensive formula is the wildly bullish outlier here, at 1075, heavily rewarding the bank's massive asset base and book value. However, literally every other lens, from Buffett's strict standards to the modern quantitative DCF and dividend models, suggests the true intrinsic value clusters pretty tightly between $7.60 and $8 per share. But hey, we have to look at the objective reality of the business itself. On the plus side, their strategic shift is actually working. Their net interest margin is expanding to 2.24%, and management is relentlessly buying back stock. But, the risks are real. They're dealing with some stressed commercial credit, they still have heavy borrowing costs from the Federal Home Loan Bank, and that overall return on equity is still fundamentally sluggish compared to top-tier banks. Which brings us to the final verdict. Impartially speaking, looking at the totality of the data, Capital Federal Financial is a solid hold at its current price of $8.62. If you strictly follow Benjamin Graham, you might actually hit buy right now. But for the value purists out there aligning with Buffett or the rigorous math of the DCF, you're going to want to wait for a slight dip into the $6.50 to $7 range to secure a true margin of safety. In the meantime, exactly as Peter Lynch might suggest, it's a perfectly fine stalwart to hold, letting you collect that sweet 4+% dividend yield while you wait for the market to move. I want to leave you with a provocative question to chew on. In a banking environment where margins literally dictate survival, does Capital Federal's relentless, massive share buyback program signal a hidden catalyst that management sees on the horizon? Or does it simply mask a fundamental lack of better growth options? Thank you so much for joining me on this explainer. I really hope this framework helps you dig deeper, ask better questions, and refine your own stock analysis moving forward. See you next time.